There's no getting away from the fact that whatever investment strategy you choose, it's bound to involve at least a degree of risk. People are generally much happier talking about returns, but it's essential before you make any investment decision that you fully understand any risk you might be taking. Risk and return are in fact directly related to each other. The returns you receive are a reward for the risk you take. No, that doesn't mean that taking risk guarantees a positive return, otherwise it wouldn't be a risk at all. But you can't expect your money to grow unless you're prepared to accept the possibility that you might lose money, at least in the short term.
This relationship between risk and return has to do with the uncertainty of the return and then the price that a willing buyer is willing to pay based on that uncertainty. So let's assume I have an investment that we would expect to earn 10% a year, and you want to buy that from me. One of the first things you want to know is how certain is that 10%. And the more risk or uncertainty associated with that 10%, the lower the price that you would be willing to pay for that investment.
There are actually several different types of risk involved in investing, not the least of which is that you don't take enough risk.
The main risk for most people is the failure to achieve their desired lifestyle and other important goals. That's the number one risk that you need to be thinking of, and everything has to be judged in relation to that. If you can achieve all your goals by leaving all your money in cash under cautious assumptions, then why bother investing? But most people in the real world haven't got overfunded pensions, haven't got more cash than they need, haven't got quite enough, or don't want to save enough, or don't want to continue working until they're 100. So for those people, the risk for them is that they're going to live beyond their capital, and or that inflation is going to erode the purchasing power of their capital, or that taxes or some other catastrophe is going to destroy their wealth and take their wealth from them. But there are other risks as well. There's risks that you've got your money invested in something or in a bank account or in investments, and there's a fraud and someone runs off with your money, or there's a failure of a financial institution. That's called counterparty risk. And then the other risk, of course, is that you've got illiquid funds, but you need to spend them and you can't get your hands on them, in which case that will force you to actually borrow money and pay someone a premium for doing so.
One of the biggest risks investors face is market risk. In other words, the risk that the market will fall heavily and that you need to access your money before it recovers. But market volatility is part and parcel of investing in the stock market. Assuming your time horizon is long enough, you shouldn't really see it as risk at all.
What is the chance of a permanent loss of capital from investing in quoted markets? It would probably be nuclear war, an asteroid situation, or some other massive calamity, in which case all bets are off. Okay? So just because something is possible doesn't mean it's probable. The probability of a permanent loss of capital from investing in major markets is very, very, very low over the medium to long term. And by that, I mean 20 years plus. The possibility and probability of you having a 30% fall in value over the next 2 to 3 years is probably 1 in 3.
Another common type of risk is being too concentrated. Even in a bull market, the price of an individual stock can fall sharply. And when the wider economy is thriving, a company or even a country can still default on a bond. You can avoid concentration risk by having a diversified portfolio, reducing the chance of your overall investments underperforming or losing money.
Take the example 20 years ago that you had invested in just one market. If you had picked the right market, that would have been great. If you had picked the market that was in vogue at the time, namely Japan, you would have lost 75 or 80% of your money. If you had picked the whole world, which is what I advocate doing, you would have diversified the risk away of being unlucky in picking just one country, in this case Japan.
Avoiding concentration risk is not the only benefit of diversification. Staying diversified will create a smoother ride towards your goals. Picture 3 jagged lines representing 3 different kinds of asset. If you were to hold just one of those assets in your portfolio, you could expect a bumpy ride. But if you bundle the 3 together, the ups and downs are much less pronounced. One reason for this is that when one type of asset zigs, another often zags. Equities and bonds, for example, are, broadly speaking, negatively correlated. Ultimately, risk is a very personal matter. A portfolio that seems cautious to one investor can be highly risky to another. No investor should take more risk than they need to take, they can afford to take, or they feel comfortable taking. And whatever your own capacity for risk, it's vital to ensure that your portfolio is diversified.
In essence, people behave in ways that mean that they lose money. And you can predict that they'll lose money because of the way that they're actually behaving.
It's because the returns you end up with are so dependent on your behaviour that self-awareness is so important.
You have to know your own temperament, your own appetite for risk, your own ability to overreact in highly emotional situations. Every investor needs to know that about themselves.